Hello, my YouTube friends. I hope you're doing well. Today I'm going to talk about my dividend portfolio specifically. I was asked by one of my subscribers and viewers, so I wanted to get into it. And that's what we're going to talk about today. So stick around. Good morning. My name is Adam Kahn, and I'm the Rational Investor. I hope you're all doing well. Happy Friday. I'm going to talk about my dividend portfolio today, but please keep in mind, I know I say this in every video. Really, this is not financial advice. Not only is this financial advice, I really wouldn't recommend following the dividend account that I have specifically. I'm happy to go over one I'd probably suggest for people. Again, I wouldn't take that as investment advice either, because your situation is going to be different than mine, and it's going to be different than everyone's. I wouldn't listen to anybody on YouTube. You really need to do your own research and see what fits you guys. But I did want to talk about the account. I'll go through the positions that I hold. I actually wrote down what percentage of the portfolio it is, as well as the dividend that it pays. Um, but as I get into the video, you'll see why I don't suggest following my lead. Um, that being said, if you haven't already, do me a favor, hit that subscribe button, smash the like button, make some comments in the video. Let me know what you think. Let me know the dividend stocks you guys like. We all know that's what kind of helps YouTube's algorithm. And if you're enjoying the content, I really appreciate the support. I've been super stoked about how well the site's been doing and the subscribers and everything else. So really, I do appreciate it. Thank you all. And let's get into the account. So normally I don't put things in a specific order. This time I did alphabetical order. So you'll also see that has nothing to do with much of anything. Forgive me, I'm going to have a little bit of my coffee. Um, but when I talk about what percentage of the portfolio, I think you'll see the reasons not to follow my advice. In the end, I think you're really best off buying great companies. And if you want to gear towards dividends, there's plenty of good dividend stocks out there that are also great companies. I get a little over attracted to yield. The other thing is if I haven't talked about it a whole lot, I used to be a commodities trader on the floor of the Chicago Mercantile Exchange. Um, I was really fortunate down there, but it made me a little, have an appetite for risk and in ways that maybe it's not always worth doing. I've been very fortunate and I've gotten lucky with some of the risks that I've taken, but I don't know that I would put as large a percentage of a portfolio in some of the things I put in. I just, like I said, since I was a commodities trader, the swings were so big when I was on the floor. I've gotten used to some of the moves and they don't bother me so much. It doesn't necessarily mean that it's the right way to do things. I've also talked about I have a few different accounts. This is the dividend one. I get a little over attractive to yield because I'm trying to push the dividends to pay bills and help cover things, over different time frames of my life. I also have the account that's really a set it and forget it. I know I made some changes to it recently to kind of, you know, consolidate into a few less stocks. But I put those, what I think of, into a safe deposit box where I don't have access to make trades on it. And I'm very specific with my financial advisor of what my goal of that trade is. So they know typically I hope to hold it for 10 years or longer. And if I call them suggesting to sell it, they actually talk me out of it, unless I have real specific reasons of why I'm making the change. Now, again, this is the dividend account. First one on my list is Archer Daniels Midland. It is only 1% of the account. I also have some Archer Daniels Midland that I bought when the stock fell because it had, recently it had some bad news. I think they're a great company. It fell into the mid to low 50s, and I saw that as a great opportunity to pick up a really good company at a low price. And the dividend account, since it only pays like a 3.5% dividend, I didn't buy too much of it, even though I love the company and it's hard for me not to have some of it. So it's, as I said, paying a 3.5% dividend. It's 1% of the portfolio. But that's one of those companies, if I were building a portfolio, I wouldn't have an issue investing in. I'd probably put a little bit bigger of an amount of money into it. I really like Archer Daniels Midland as a dividend stock. So next on the list is AGNC. G like Gary. I don't know if I pronounced it well. AGNC is a REIT that has a pretty high dividend rate. They're in residential real estate and a bunch of other things. You'd actually have to go to the website, which I've done. Um, and I just like the dividend. And I was looking around when we were in DC at different companies. They kind of popped up. They pay a 15% dividend, and they're about 3.5% of the portfolio. And that's kind of why I say, typically the higher the yield, the higher the risk in a company. I don't know that a company paying 15.5% dividends is one that might be able to sustain that. Now, I hope they do. It's a small enough percentage of the portfolio. I'm really not concerned, especially because this is a small percentage of my overall portfolio. But I'm trying to push the dividends on, as I said earlier. So I look for things that have a bit of a higher yield on it. Number 3 on the list is Best Buy. Ticker symbol is BBY. I think we all know who Best Buy is. When I bought it, it was paying around a 5% dividend. My concern with Best Buy is I don't know that I see a path for growth for them. They get used. I think they'll be just fine, and not really grow as a stock, and hopefully be able to pay that 5% dividend that they offer, which is just fine for me. I didn't put a whole ton in it. Um, Percentage wise, it'll sound like more than the others because it's 7% of the portfolio. I've gotten comfortable with the range, and I kind of typically, with a small percentage of Best Buy, I will sell some calls against the position, and I also sell some puts when I get taken on the calls, if that makes sense. So, I'll sell an 80 or an $82 call if the stock closes on the week that I have that option above 80 or 82. I then get the cash for the stock and have to give up 100 shares per option. And then I'll sell a 78 or $76 put. And if the stock falls and I get filled on that, I end up buying the stock back. It is some risk. The stock can move a good bit more. I do it on weekly options, but it's a way for me to push that yield a little bit higher and gives me something to do, and I enjoy playing around a bit. So next in my account is Enbridge. The ticker symbol is ENB. They pay a healthy dividend of 8%, and it's 5% of the overall dividend portfolio. I like Enbridge. I like a lot of the energy stocks. I think they've been oversold. I've been picking them up over the past few months because I think they're all oversold, and I see a lot of good opportunity in a lot of the energy stocks. Again, not financial advice, but Enbridge essentially deals with, from what I understand, the movement of energy and oil and gas and things like that. Um, they pay 8% dividend. They've been around a long time, and I think I can rely on that payment, which is really the goal of the dividend portfolio for me. So next in my list is one that I actually have in the safe deposit account, and I just kind of play around with a tiny bit of it because I like the company, which is 3M, ticker symbol MMM. It's only 1% of the portfolio, but they're paying a 6.6% dividend, which I think is awesome for 3M. They've had some um, they've had some legal issues which drove the stock lower and causes some legitimate concern. But I kind of put it in that camp of bad news on a great company. I mean, 3M is really well diversified, and my guess is in 2, 3, 4 years, the lawsuit will be handled, whether that means they're making the payments and able to make up the income by raising prices or whatever they need to do to make themselves profitable. I'm guessing they'll get past it in one form or another. I said to somebody in my office recently, and well, I'll wait until I get to that stock because it's the next one on the list. So next on the list is Altria Group, which is the ticker symbol MO. It pays a 9.5% dividend. It's only about 2% of the portfolio. And if you guys are adding it up, know that like the percentages are A, they're not going to be exact. And B, I also keep some cash in the account in case there's something that comes along that I want to purchase. And if I want to sell puts on a dividend company, which I don't know that I always advise, that the volatility isn't so high that the math makes sense. But sometimes if it's a company I really want to own, maybe I'll pick up 20 cents over a week in the hopes that the stock price gets below my put because that's where I want to buy it. Anyway, with Altria Group, I had said to somebody recently, every 10 or 20 years, they seem to get in some lawsuit that scares the market, makes people nervous that the government's going to shut them down or put regulations on it. It drives the stock price lower, it drives the yield higher. And usually, in another 5 or 10 years, everybody's forgotten about it. The stock's drifted higher, and you've picked up a great bargain. Now, one day it's possible that they lose the lawsuit, they get put in a really bad position, and it ends up being a terrible decision to have bought the stock at that time. Well, that hasn't happened for 30 years or so, but I don't want to dismiss it as it can't happen because it can. But I do try to pick up companies when bad things are going on because typically once they get past those things and people forget about it, the stocks drift back up. Like I said, one day maybe it doesn't, may not be the best idea all the time, but it does seem to work out time after time. Now, I think you'll see here why I kind of say you shouldn't follow my advice if you're following my dividend account. Next on my list is NEP. It is NextEra Energy Partners. NextEra Energy Partners is 32% of my dividend account. Why? Well, I think they're doing okay. The news that came out was they had to cut their future growth of where they think they're going to be able to raise the dividend over the next few years. Instead of it being around 15%, they dropped that to 5 to 8%. It pushed the stock down to like $24, $25 a share. It's still around 27. Currently, it's paying a 13% yield, which really attracts me. And when I was buying it, it was paying like 15, 16% yield. And the problem that they were talking about is the rate that they could still grow the dividend. That doesn't sound so terrible to me. If I can get a nice big dividend like that, and it's going to continue to grow over time, that doesn't sound like a major problem. I actually reached out to the company, and the information that they shared with me is that their contracts are in place until 2027, so they're pretty comfortable with that guidance. They don't know what to predict past that because they don't have contracts in place yet. But NextEra Energy Partners is essentially a sister company or a subsidiary of NextEra Energy. They actually don't even have employees because NextEra Energy runs it. They're the wind and solar division. They used to do gas as well, but they sold that off to Kinder Morgan and to raise some capital and to become 100% sustainable. So I think it's really cool. And NextEra Energy is a great company that I don't really see going anywhere. Now, of course, that could change with NextEra Energy Partners. I really don't advise somebody putting that large a percentage of their portfolio into one stock. And it's why I say you really shouldn't follow me. Um, and I don't know that this fits in my category of a great company that will grow over time. I just think if it gets back in line of where it should be in terms of what the information is, I think it should be a $40 stock. Now, maybe that doesn't happen, which is why I say don't follow me. But if I can get that nice yield and the stock appreciates the way I think it'll end up really well. So I have a rather large percentage in it. Next one on my list is a company I call OHI, but just because of the ticker symbol is OHI, it's actually like Omega Health Partners. And they're a REIT as well, but they specialize in healthcare facilities where they own the property and rent it out to the people who run those facilities. They pay a nice big dividend of almost 9%, and it's 7.5% of my portfolio. What I like about it is they've been around a really long time. They made it through the dot-com bubble and burst, and still paid their dividend all the way through. They don't have a lot of growth in the dividend rate, but I'm okay with that because I'm happy with what it pays. So as long as they're able to continue to make those payments, I'm good with the company. I know some people don't love the investment because they don't see it really growing over time. I don't know what I think. They actually bought a lot of their own stock at a really good level, which tells me they pay attention to it. If I remember, between like $25 and $28 a share, they invested more money into their own company, and they've been expanding. I think healthcare for retirement communities is a good space to be in. It's going to have demand as the populations get older. So I think they're going to do just fine and be able to pay that dividend. So the next dividend stock in my dividend account is also one that I have in the safe deposit box. I bought a smaller amount here, but I really like Pfizer. I think they're a big company that's been around a long time. They were getting a lot of profits from the COVID vaccines that they don't really have anymore. It's caused the stock to be out of favor. It's caused it to drop a ton, and it's paying like a 6.5% dividend right now. And I have it as 5% of the dividend account. I guess I assume they'll be able to pay their dividend going forward, and if not, they might lower it a little bit. But I just think Pfizer's a great company. I really don't see them running into major problems. Now, that can happen with any company. I don't want to tell you it can't happen because obviously it can, but I don't know. I put it in the safe deposit box. I figure they're out of favor. I figure in 5 or 10 years they'll be just fine. They'll probably invest in other companies to get new drugs in their pipeline and continue to grow. I think they've been doing this for such a long time, they probably know how to run things, which is kind of what I look for in a company in general. Um, Next on the list, look at that. I didn't even hit pause. Stock ticker is PFFA. It's like InfraCap or Veritas InfraCap Fund. They essentially invest in preferred stock. What I like about them is not only do they pay a 10% dividend, they pay monthly, which I really like. I have a rather large position in it because of that. It's 20% of the portfolio, but preferred stock is not something I invest in personally. So I felt like if I put a large percentage into a fund, that diversifies me into that field without me having to start learning a ton about it and finding the companies themselves. The interesting thing is, when I looked up what they're investing in, most of them pay a 5 or 6% yield. So I'm guessing they use margin to really push the envelope to get that 10% return. I didn't dig into it a ton. I'm sure some of you may know better than I do. I'm just happy that I've had it well over a year. They've been paying their monthly dividend. I actually put a tiny bit in my son's account that we kind of use like his allowance. So I think it's pretty cool. And then last on my list is Starwood Properties. STWD is the ticker symbol. It's a little over 3.5% of my portfolio, and they're paying a 10% dividend right now. Starwood, if you're not familiar with them, has a bunch of different hotel chains. They're all over the country, a lot of hotels and motels and places that you might stay overnight in. I think it's a great space to be in. And my guess is, they're another REIT. My guess is they'll do just fine. That's a nice big dividend. Now, I know I've been saying it. You can obviously see from my portfolio, I'm a little over attracted to the yield, but this is a small percentage of my overall portfolio, and it really is just to push some dividend payments. It probably isn't properly allocated depending on what a person is looking for. And if somebody were building a dividend portfolio as their primary portfolio, I think they're better companies to invest in. Now, for me personally, this kind of fits my goals. It kind of fits what I want to be doing. I need to push the envelope for those yields because I have a different account that gets me growth and has me into a different space. And then I even have another account that's kind of a fun account for me to trade, which is the smallest of all of them because, you have ups and downs with trading. And I can tell you from my experience, the account that's done the best for me is the one that just sits and does nothing. Does incredibly well. Um, and then the dividends are really nice. I'm able to use those to pay some bills, maybe go on vacations and whatever we need to help with. Anyway, don't forget again, thumbs up, like, subscribe, make comments. Let me know what you guys think. Happy to do another one where I can make what I think is a better rendition of what I would do as a dividend account if I were really focusing a majority of my account into dividends. So feel free to ask questions. Have a great day. I hope it's as beautiful by you as it is by us. Um, have a great weekend. I'll probably talk to you one day this weekend, if not both.